Welcome to It's the Economy. The Indian economy has enjoyed a string of positive developments. Indian government bonds will soon be part of global indexes, bringing in at least a handy $30 billion of inflows over the next 18 months. Separately, inflation, especially core inflation, for the latest month came in way lower than expected. Negatives, of course, include the rise in US yields, steady rise, and, of course, the rise in crude prices. But the bigger question for us is, how do we relate all this to stock markets? I have with me someone who handles exactly this. Neelkanth Mishra, Chief Economist, Axis Bank, and Head of Global Research at Axis Capital. Neelkanth, good morning, and thank you very much indeed for joining me. First up, the latest news, the inclusion in the JPMorgan index. We understand 30 billion only because of this over the next 18 months. And Bloomberg Barclays inclusion, if that comes, then maybe another 10 billion. So your idea of the numbers and, more importantly, impact on macros.
So it's not just important to look at the numbers, but also the timing of that. I think the JPMorgan GBI EM should be about $20-25 billion. There is reasonable likelihood that front loading may not happen. You would think, given how things happen with the equity indices, that before a stock is included, there is a lot of investment that occurs. And then when the passives start coming in after index inclusion, then those stocks are kind of handed over to them. Yeah. In this case, prior evidence looking at what happened in China or Indonesia suggests that a significant amount of front loading may not happen, so there is that evidence. The second part of inclusion in the Barclays Bloomberg Global Ag is something that at least for the next 12 months, I think the likelihood of its inclusion appears low because of the requirements that they have and. Therefore, this is all probability. In fact, finally, it is the collective wisdom of all the investors who are anchored to that. In our view, given that the BBAG is a much larger index, and India's potential weight in that may not be that significant, the likelihood of investors really pushing hard is lower than it was in the JPMorgan Global Emerging Markets Index, where India's weight, even to start with, is 10%.
Okay, fair enough. But what does it do to macros? Assuming 30 billion, my assumption was that some active funds will also come in, anticipating that the passive funds will come. Even if they don't front load, even if they come along, what does this do to macros? Easier financing of fiscal and current account deficit, lower yields. How do you see macros playing out?
Yes, definitely. I think the impact on yields should be to bring down the duration. That is the impact, the gap between the 10-year bond yield and the repo rate. This is something, if you remember, in the last several years, I've been observing that there is not enough diversity among bond buyers. So I think 10-year bond yield should ease off. But do remember that the gap between the US 10-year and the Indian 10-year is now at 2005 levels, right? So it's about 18-year low. So given what is happening to the US government bonds, the Indian government bonds may not be incrementally that attractive. And that's perhaps the reason why front loading may not occur, right? Because, see, we can look at history and see how things happen, but history will only give us some hints because there's always a local context. Like when Indonesia was included, there was no visible, acceleration in flows because by 2014, 40% of Indonesian government bonds were already held by foreigners. So after the inclusion, that share did not really go up too much.
Okay. Yeah, it's just a one-off flow, that I agree. But at the moment, does that make banks a little more attractive because of their bond book? And what other advantages, lower cost of capital, any other advantages?
Yes, I think it provides significant macroeconomic stability. right? So given that because of what has happened to the US 10-year bond yield, which is the risk-free rate for the whole world, for financial assets in the whole world, and the fact that the recession in the US has only been delayed, not averted, means that the next 12, 18 months are going to be choppy, or at least it's reasonable to assume that they're going to be choppy. And in that environment, to have a $25 billion inflow, which is coming in, will keep the market stable. So that
Okay.
I think helps the macroeconomic stability for the country.
Okay. Okay. Yeah, actually, I saw your very interesting note, and we are running some key takeaways from that on the fact that term premium in the US has risen. I mean, there's a sharp rise in yields, and today it's heading towards 4.6%. That's what, 50 basis points in 10 days is what US yields have, 10, if not 10, 15 days is what US yields have risen. Now, what does this mean to Indian stocks, to the way smart money will move? Do you think for now we should count out foreign funds altogether?
Absolutely, and this is something that I've been saying for several months, that the US policy is an inversion of what they did after 2009. So they were doing monetary easing and fiscal tightening. Right now, they're doing fiscal easing, or they have an easy fiscal stance, and they are tightening monetarily. And the reason why the 10-year bond yields have gone up, most people intuitively think it is because of higher inflation. But if the 2.5% increase in the 10-year bond yield was to be broken down into three parts, only about 30 to 50 basis points is because of inflated or higher inflation expectations. So that's a very small component of this increase in yields. A very large component, as you also hinted and we've written about, is the rise in the term premium. The term premium is a reflection of uncertainty in interest rates, right? So the volatility in interest rate expectations has gone up significantly, and there is no reason to expect that this will ease off anytime soon. Remember that the U.S. federal fiscal deficit was supposed to be 5.4% this year. That itself is quite high for an economy which is above its pre-pandemic trend. This is the only economy in the world which is above its pre-pandemic trend, let alone the pre-pandemic level. Despite that, now their current run rate is more than 3% points of GDP ahead of what was budgeted. Yeah. And given that this is happening because of a shortfall in tax collection, and somewhat like the Indian government, a lot of their expenditure is non-discretionary, it is very likely that these rates will be elevated. What is also happening is that the price insensitive buyer, remember that there was a time when 30% of US government treasuries, US treasuries were held by central banks, which were trying to accumulate reserves, and they were somewhat price insensitive. That percentage is coming off very sharply, and therefore the term premium will remain elevated. And there is a third point, which I think is also an important driver, which is that generally the real neutral rate in the US has tended to follow the trend growth. So if trend growth was 2%, it would be 2%. After 2009, when the US started to tighten fiscally after all of the recapitalization that they did, and all the burden of stimulating the economy came to monetary policy, there was a 1% point gap that emerged between trend growth and the real neutral rate, which is just called R star. Yeah. This, we think, is starting to narrow, and therefore it is, even if inflation was to ease, US 10-year yields will remain quite elevated. It is only after, I think, a recession is hit that these rates may come off.
Okay. Yes, but there is one takeaway from the Fed, which you perhaps have not written in your note, and so I wanted to ask you about that. Their GDP assessment of 2023 is double what it was in the June statement. June statement, they said GDP 1%, now 2.1. So clearly US growth is stronger. Would that keep our equities also, I mean equities in general and ours as well, therefore well bid?
So if you have a fiscal deficit which is 3% point higher than what was budgeted, for the GDP growth to be 0.5% or 1.5% higher than what was expected is somewhat intuitive, I think. So at the risk here and the fault line here is emerging on the fiscal side, and therefore, and the fact that you ask the best of Indian corporates which borrow in the global markets, dollar funding is dried up. So if you're getting 4.5, 4.6% on US government bonds, and on AAA, AA paper, you're getting 8-9%. Why will dollars be available to anyone else? And similarly, I think, and so to answer the question you asked earlier about the impact on the Indian equities, I think so growth, yes, I think the growth remains supported till the time that it cannot, right? Basically, in our view, the higher interest rates, so given that they were low for so long, and people had also extended duration, right? So when you have a sustained period of low rates, what happens is people go up the risk curve. So more than 50% of the investment grade bonds are BBB, right? Basically, they're just one notch above investment grade. So there's a significant deterioration in credit quality, and people extend their duration. The duration, as per some research, between 2006 and 16, more than doubled among this corporate bonds. So therefore, the impact of higher rates will show up with a longer lag than it would have otherwise, right? So, so I think that the recession has only been averted, and therefore I think we need to be very cautious when we are thinking about extrapolating the current surge in growth in the future.
So second half FY24 or second half calendar 24, we better beware.
Correct. And because that's when the recession or the loan rollovers start becoming much more meaningful, and therefore the economic impact will start showing up. Remember that markets tend to act 3 to 6 months ahead of the actual economic development, and therefore that may not. And remember that the biggest impact is going to be on valuations. Everyone, and this is something we discussed the last time I was on your show as well, everyone has the muscle memory of the previous decade where every time PE multiples fell, you went and bought and you were rewarded for it. And that lesson, that Pavlovian response, is something that we need to unlearn because these rates are going to be higher.
Oh, if anything, valuations are higher than their historical averages now, standard deviation. Oh, I can't let you go without telling us something about stocks. What's the advice, therefore? Continue in large caps, continue in financials, avoid the mid-cap trap. What's the advice?
You summarized it for me, so I will not waste your audience time by repeating that. But I do think that the fact that there is a surge in inflows which is purely domestic, and the valuation discipline because of higher foreign holdings is being brought along much better in the larger caps, which is why our preference remains for the larger caps, right? So we are believers in the India growth story. We also think that Indian flows will remain elevated. But where there is no external valuation discipline that is coming in, I think mid caps and small caps, there is a lot of frothiness that is coming in, and we would stay clear of that.
Okay. Thank you very much, Neelkanth. I'm really sorry we're out of time because I'm not out of questions, but I'll take a rain check for another interview or another day. Thank you very much for joining us. But that's very important advice. We are all arguing for higher valuations. Here is a very clear argument why, if anything, valuations will have to be discounted lower because of the higher yields and likely continued higher yields. On that note, wrap up on Bazaar Chartbusters coming up.